After getting a bad rap over the last decade, hedge funds seeming to redeem themselves this year. Several in the industry reporting major gains so far this year. Yahoo Finance's Alexandra Semenova joins us now with more. And Alex, I guess some of these hedge funds really capitalizing on the changing market conditions that we have certainly seen throughout the year.
Exactly, Shauna. The hedge funds have been scrutinized over the past decade, and rightfully so, because performance has been lackluster and they charge some of the highest fees in the investment business. Just taking a look at last year's performance, hedge funds returned an annual 10.3% according to the Hedge Fund Research Weighted Composite Index. Meanwhile, the S&P 500 returned about 27%. And sure, different hedge funds employ different strategies, so it's not necessarily fair to compare them this way. But when you're looking at the industry broadly and seeing that unmanaged regular stock indexes are outperforming the industry when they're charging such high fees, that's really not a good look. But this year, however, did mark somewhat of a reputational turning point for the industry. Citadel was among this year's standouts. It's on pace for its most profitable year ever. As of November, its Wellington fund is reportedly up 32% year to date. Around that time, the S&P 500 was down 14%, now down even more. And Citadel performance was so good that Ken Griffin actually took his employees to Disney World. He paid for 10,000
sign of a good year.
His employees and their families for a three-day trip to Disney World. And then you have others like the D.E. Shaw Group, Millennium Management, all set for double-digit returns. And another point to make here is the Texas Teachers Retirement System actually performed much better than some of its pension fears because of its hedge fund allocation. So it was able to offset some of the losses in its stock and bond portfolios. Now, to be sure, it wasn't all good. There were a lot of hedge funds that did severely underperform. You have Tiger Global Management, which bet heavily on tech stocks, down more than 50% year to date. Melvin Capital completely shutting its doors. A lot of others that didn't do as well as Citadel and some of the good ones. But the point here is that this year's market drawdowns and the unexpected geopolitical risks that we've seen have really helped hedge funds reassert their place in investors' portfolios during a really challenging year.
So I know Coldplay played at that Citadel party. I heard about that. But what does this mean sort of for the industry going forward? People looking at how can I trade like a hedge fund? I mean, can you? I don't think you can. But where does the industry go now after such a banner year in 2022?
Yeah, so the struggle for hedge funds really started after the global financial crisis. We've seen a period of really easy money policies, stocks generally on an uptrend, and investors doing quite well. This really limited dispersion in the equity market, which is the range of possible outcomes for an individual investment. And now that we're seeing the Fed tighten conditions, and we're not expecting the bull markets that we've gotten in the past, hedge funds may really play a role in investors' portfolios going forward. Warren Buffett in 2007 famously bet that over the 10-year period ahead, the S&P 500 could outperform hedge funds, and he was right. If he made that bet over the past 10 years, he'd still be right. But over the next 10 years, might not be the case. We're probably not going to get the type of bull markets that we've seen with higher rates ahead, concerns about growth, geopolitical tension still high. So hedge funds might be, shining bright coming ahead.
Well, I could hedge my checking account at some point. Anyway, Alexandra Semenova, thanks so much.